You may access Bursa Academy by scanning the QR code on your screen now, or by going to www.bursaacademy.bursamarketplace.com. Our topic for tonight is BMD FM70 Index Futures Series number 2 of our 3-part series. Tonight's series is called Strategies You Need to Know for Trading Stock Index Futures. Ladies and gentlemen, before we continue, questions will be open to you through the chat feature in the Zoom platform, and your questions will be addressed by David Lowe after his presentation during the Q&A session. Please tag your questions by mentioning your name, where you're from, and your question. I repeat, you may type your questions in the chat feature. Please make sure you tag your questions by mentioning your name, where you're from, and the question. Our panelist for tonight's event is David Lowe. David is a trader and managing partner of Exmodius Trading Group, PLT. David has 24 years of experience in Malaysia's listed derivatives industry before starting his own consultancy. David held leadership positions in futures brokering divisions of major investment banks in Malaysia. David also served as the president of the Malaysian Futures Brokers Association between 2018 and 2019. David has also spoken in seminars and workshops to over 5,000 retail traders on trading Bursa Malaysia derivatives, as well as the CME, Singapore Exchange Limited, and Hong Kong Stock Exchange markets. His work includes live market trading sessions and webinars. So without further ado, ladies and gentlemen, I will hand the screen and the floor to David.
Thank you, Ryan, for that fantastic introduction. Just let me switch the screen so that I can get you to view my screen. Okay, Ryan's going to pass me the reins to the controls.
Okay, you should have controls.
Okay, yes, let me click this. Okay, let me go to my screen. Okay, I hope you're seeing the same screen as where Ryan stopped just now. Okay, so that's, so Ryan, everybody's good on the screen?
Yep, all good seeing you.
Okay, fantastic. And good evening to everybody. Welcome to our webinar. I hope everybody is keeping safe. We live in very interesting times. So this is the second day of the MCO for us in Kuala Lumpur. And to all our friends out there, keep safe. Stay safe and stay healthy. Whilst you have some time during this time, if you are working from home or you don't have any entertainment to do, then I think this is a perfect time to learn something. And for this session tonight, big thanks go to Bursa Academy for hosting this event. We have lots to share with you tonight. And this is actually the second part of a 3-part series of BMD FM70 Index Futures Trading Series. This is the second. A couple of weeks back, we had the first session where we talked about how to get started on the right foot with index futures. We covered things like contract specs, what are the contracts, index futures contracts traded on Bursa Malaysia derivatives. We covered the FM70 contract. We covered the FKLI contract. We spoke about also margins and why using the index futures contracts, you can actually enhance your trading and investment returns. Okay, we will cover some of those again today, but those are the things that we covered. But we'll jump right in today. Okay, and this is what we're going to learn for this session. Just a minute. Let me just click through. Okay, tonight this is what I will be sharing with you. We will be talking about day trading and position trading using index futures. What is the correct strategy to use? So we will consider your goals, whether it's short term or long term or mid term, and what are the trading strategies which are suitable for you in this kind of situations. I will be specifically sharing with you three different strategies tonight, and each of them will have different features, and it's something that you can pick and to see whether that fits your trading strategy or fits your trading style. We will also be talking about how to spot profitable trends. All right, when to trade and actually when to stay out. So this is very important. There are times in the market that it's better to be a sideline in the market, watching for an opportunity, and there are also times that you really need to jump in and take a trade. So we look at different areas of where we can actually also implement our trade exit and entry plan. Okay, that's tied up with the second bullet point. When to trade, when to stay out, and also how to get in and how to get out. Okay, we'll talk about stop loss and profit taking strategies as well. So once you're in the trade, what should you do if trades go for you, and what if the trades don't go for you? What you should do, and I'll recommend some essential tools for fine-tuning your strategy. Some of you may have your strategy already, trading some other products, or even some may be trading the index futures already. So we will also share with you some of my tools that can be used to enhance, hopefully, some of your strategies that you may already be trading. Okay, so that's what we're going to cover tonight. That's a lot of material as well. But before we jump into the full thing, a quick recap on what we covered previous week. Okay, we spoke about the FM70 index futures contract, which is based on the index of the Bursa Malaysia Mid 70 index. This index futures contract was launched in 2018, and it was redesigned and revamped and relaunched on 14th of December, just a month ago. Right, so the main changes for the new FM70 contract is the revised contract specifications. The contract size is slightly larger now. It's basically the contract size is the FBM Mid 70 index multiplied by 4 ringgit. Previously, it was 2 ringgit. Now it's multiplied by 4 ringgit. And the minimum tick size has also been enlarged to 5 points. So every single movement in the ticks in the FM70 contract is 5 points, which is equivalent to 20 ringgit. Why is it 20 ringgit? It's basically 5 points times the 4 ringgit each point, right? So that's the main difference after the changes on the 14th of December last year. So now it's a slightly larger contract, but it's got its advantages being slightly larger. It's easier to manage the trading cost, as well as you will find that the tick size is more friendly towards your movements in the index, and also will impact, of course, how you make money. So that's the FM70. This is the contract specifications for the FM70. So I just wanted to highlight some of the points. This is something they covered last session, but we won't go through every single point. But just to remember, for the contract size, we said just now is multiplied by 4. So if the FM70 currently now trading about 14,800 points, the contract size is that index points multiplied by 4. So the minimum price fluctuation is 5 index points, equivalent to 20 ringgit. So every tick, every movement, minimum movement in the FM70 is 20 ringgit. So the other thing I wanted to share with you also is here, margins. We spoke about margins in the last session. Margins are basically the minimum deposits that you need to hold one contract in any particular futures contract. So in a sense for FM70, the minimum to hold one contract, outright contract, is 2,500. So that's the minimum capital to hold one contract in the FM70 futures contract. The spread margin is something that I'll want to talk to you later. One of the strategies we're talking about is spread strategy. A very interesting strategy indeed. We will elaborate later. The spread margin per pair, okay, because spreads trade in per pair, you will see afterwards, is only 350 ringgit, okay? So this will be relevant when we would be talking about spread trading later in the slides. So this is the 3 points I want to highlight to you on the FM70 contract. So in terms of looking at the bullish, whether trading bullish markets or bearish markets, and those of you who have joined us before the session started, you've seen some examples of the calculations. But we'll just go it quickly just to give you an understanding for those who are totally new in index futures. Basically, just now we spoke about the FM70. Every single point is 4 ringgit. So here is an example. If you are bullish and you're buying a position in the FM70, and suppose because this example was given last month, we are trading the December FM70 futures last month. This month, of course, we're trading the January contract. So if the FM70 at the time was trading at 1400 and you were bullish, you bought one contract of FM70, and if the FM70 rose to 15,100, you will have made here 200 points, right? 15,100 minus 14,900 is 200 points. So 200 points multiplied by 4, every single point is 4 ringgit, you have a gain of 800 ringgit. Okay, that's how you calculate. Of course, on the downside, if you were not right in your call, you bought and the market dropped to 14,700, you would have lost 200 index points multiplied by 4. So in that sense, if you bought expecting the markets to go up, but it didn't, and it came down by 200 points, then there will be a loss of 800 ringgit in value. Right, so this is a quick calculation just to get everybody in sync. Later, we'll be talking about this. So this is in the bearish market. So in a bearish market, if you are bearish, of course, you would short the market. That's one of the unique features of trading index futures markets. In trading stocks, of course, it's a lot more complicated and complex to short the stock market, but you can short an index easily. A futures contract and index futures, you can short it. So if your view of the FM70 is you are bearish on the FM70, then you could take a position. Let's say, for example, here is December's FM70 futures contract trading at 14,900. You short sold one contract at 14,900 with the expectations that the markets were going down. And if it did, right, if indeed the December FM70 futures contract was to drop to 14,700, you would have made 200 points in difference from 14,900 drop to 14,700, 200 index points multiplied by 4, you will get your 800 ringgit in profit, right? So the market actually went down lower. So in terms of shorting a market, when markets go lower, you will make a profit. But if the December FM70 futures were to rise to 100 points, then you'll be in losing positions because you're expecting markets to go down, but the actual market went up. So in that sense, if markets rose to 1,500 and 15,100, there'll be in your futures contract, there'll be a 200 index point loss multiplied by 4, there'll be a 800 loss. So that's basically how you calculate the P&Ls for trading in the index futures markets. So let's go on and quickly cover the FKLI. FKLI is the other contract that we'll talk about in the index futures. This is the very active index futures market. It has been there since 1995, many years in the market. This is basically a contract where you trade the top 30 stocks of the KLCI, and the points are a bit different. The contract size is multiplied by 50, so it's a larger contract compared to the FM70. The minimum tick is 0.5 points, equivalent to 25 ringgit. Okay, a lot of you may be familiar with this contract because it's already been traded for quite some time. So this is the contract specs for the FBM KLCI futures. In short, we call it the FKLI contract code. Again, contract size is every point multiplied by 50. So the contract size is the index now multiplied by 50. And the minimum point, we say it just now, 0.5 index points. Every single point, the minimum tick is 25 ringgit. Okay, so let's take a look at the margins. Margins, the outright margins per contract is 4,200. That means that's the minimum amount of capital you need to have in your account to trade one contract of FKLI, 4,200. Okay, and again, please note here, there is a spread margin. If you're trading spreads, spreads margins are usually lower, and it's 750 ringgit per pair of spreads, okay, which later we will cover on this. So to trade one FKLI contract, you need to have a minimum of 4,200 ringgit in your futures trading account. Okay, so let's move on. We have covered the basics of what the FM70 and FKI contract. So now we go to this. So now that, let's say, for example, you're interested in trading the index futures contract. Okay, so these are the questions that will come to mind. Okay, which contract, FM70 or FKLI, should I trade? Okay, what time frames do I trade a short term? Do I trade day trading, or should I take a position trade? Okay, and what sort of analysis do I use? Is fundamental analysis good for trading futures, or is technical analysis better for trading futures? Okay, so this thing about fundamental analysis and technical analysis is a question that a lot of traders have asked, and the debate goes on. Okay, but to me, the fundamental analysis is very useful. But it depends on the time frame that you are trading. Okay, I use mainly technical analysis because I trade on the shorter time frame, and later you'll see why. We'll elaborate on that. Fundamental analysis is good if your view of the market is longer than perhaps 4 weeks or a month or two. Okay, so from mid-term to long-term, the fundamental analysis is most helpful. So in terms of if someone were to trade the longer term kind of view, then I would suggest looking both at the fundamental analysis and technical analysis itself. So it's not really a debate, it's just a matter of time frame. The reason why a lot of people use technical analysis in trading futures, and especially index futures, is because of the shorter time frame. Okay, so technical analysis helps is more useful in that sense. Okay, because some of the time frames the trading horizons can be very short. It can be day trading. Okay, day trading are traders who trade within the day. That means they go into a position at the opening or sometime in the day on when the contract is market is open, and then they get out within the same day. Right, so it's a very short-term trading. Some trade perhaps T plus 5 days intra-week, and some traders take 2 to 4 weeks positions or even longer. Okay, so that depends. Each type of trading has its own features, has its own different types of risks, and has its own capital requirements, including your level of experience as well when you're trading, whether short-term or long-term. Okay, so in terms of finding which futures contract is suitable for you, you also have to look at your risk capital. Okay, do you have more risk capital? If you have a larger risk capital, of course, then you are able to trade a larger size contract, right? So just now we were talking about contract sizes. If you have more capital, of course, you can trade the larger contracts. Okay, and just now we spoke about the time horizon. The longer term positions, of course, you'll be subjected to more volatility. So in terms of holding a long-term position, you will have, in that sense, face more movement into your account. Right, so those are the considerations when you're talking about which futures contract and what time frames to trade. Okay, and lastly, of course, is your own risk tolerance as a trader. Okay, if you have a higher risk tolerance, perhaps you may prefer to take the bigger trades, right? And if your risk tolerance is perhaps more conservative, then you may want to trade the shorter time frames. So that depends on the strategy, which is something that we will elaborate in the next couple of slides. So let's move on. Okay, shall I trade short term? Shall I trade day trade, or shall I do positions trading strategies? Okay, so these are the comparisons between day trading and short term, and also position trading. And you will notice over here when we talk about position trading, even in futures, position trading, people are talking about between 2 to 4 weeks. Okay, in terms of trading shares and stocks, of course, 2 to 4 weeks could be a relatively what do you call that, a short period of time to hold a share, right? Because when you're trading shares, a lot of these equity traders or investors hold for many years, right? So comparatively in futures, the traders trade even when they talk about position traders, is relatively short term compared to equity, right? So medium term to position trading is like 2 to 4 weeks of holding periods. Okay, of course, for day trading and short term trading, day trading is intraday within the day, and for short term, we are talking about 2 to 5 day holding periods. So very, very different propositions. If you if you were to compare to traditional investing in equity markets, right? So in terms of day trading or short-term trading, what are you looking for? You're looking for either, number one, trading specific news events. Okay, there may be some news events coming up. Okay, or economic or political events. Okay, so in Malaysia, volatility tends to be very high during the what do you call that, election period. So some traders come in and actually trade those kinds of specific news events or situations. Okay, but a lot of traders trade day trading and short term because of the intraday volatility. Okay, as you noticed in the last a couple of weeks, there have been a lot of volatility in the global markets as well as for our Malaysian markets because of the news flows and all that. So a lot of traders, because they feel that there's a lot of this movement in the intraday volatility within that particular, say, contract FKLI or FM70. So they will specifically go in there and hunt for this intraday volatility. And intraday volatility can be quite lucrative as well. Okay, and in terms of trading intraday and short term, of course, because you don't hold the contract for too long, you are not exposed so much in terms of the time and the potential move. Okay, so in terms of day trading and short term, in terms of compared to, say, position trading and 2 to 4 weeks, you may be not what you call that, exposed to so much of the price volatility. So some traders prefer that. Okay, and so when you are trading day trading or short term, traders tend to use technical analysis charts in the time frames of 15 to hourly charts. Okay, these are the favorite time frames for traders who are looking at day trading or short term trading. 15 to 60-minute charts. Whereas in comparison, in terms of position trading, most of the traders will look at chart time frames of daily charts. Okay, because they are trying to capture larger price trends. Okay, they may identify a trend on a daily what do you call that, chart, and they want to ride this trend. Okay, or they feel that the trend has changed. There's a swing in the trend. Okay, there's a turn in the market, so they are looking for this turn. So in terms of the chart time frames, they're looking at the daily charts because they're trading for larger what do you call that, move. Right, so this is a comparison and the difference between day trading and position trading. Okay, we will elaborate on these two different strategies in more detail. Okay, so the first strategy, we talk about position trading. Okay, this is outright. Outright, what does it mean? Outright means that you're taking a view either long or short in the market. Okay, outright is something that is a technical term that we use as compared to, say, spread trading. Okay, so this outright is just a term that we're basically taking a position where you are either a long, that means your view is the market will go up, or short with the view that the market is going go down. Okay, so in terms of a position trading, what the trader wants to see is a time frame of 2 to 4 week horizon. Okay, depending on your market view, whether you're bullish or bearish. Okay, so you could go in and buy, say, one contract of FKLI January 2021, or if you are bullish, or you go and short a FKLI January 2021 position if you are bearish. Okay, so the profit potential is, of course, the difference between the position when you got in, whether long or short, and at the end of the time, that 2 or 4 week horizon, once the trend has moved, what is your selling or buying position at the end when you liquidate. Okay, so that's the profit potential. Now, what is the rationale? The rationale of trading at position trading, of course, we spoke a bit about it just now, is you want to capture a larger price movement within the trend. Okay, you identified a bullish trend. Okay, you think that this trend will move for some time, so you ride on this particular trend. Okay, or if you have identified a turning point, okay, in this trend. So let's say, for example, a downtrend has now turned into a uptrend. So by trying to catch this trend earlier and holding it, you're trying to maximize that particular move in that trend after it changed. Okay, so that's the rationale of position trading. Okay, now in terms of capital required, of course, you'll be holding these positions overnight, right? Because you're holding it for 2 to 4 weeks. So in terms of the full margins, of course, it will be applied the FKLI margins, just now we spoke about it, it's 4,002 for FKLI, and for FM70 it will be 2,005. Okay, so these are the minimums. Of course, most of the time traders who have position trading, because there's movement and the P&Ls is up and down, they will put more on that. They will have a buffer. Okay, they wouldn't just put exactly 4,200 ringgit for trading FKLI. They will have some buffer so that they don't get margin calls so often. Okay, or they don't want the bothersome day-to-day in and out of the funds into their account. So they will have some buffer inside the account. Okay, so in terms of position trading, I want to show you an example of the last year for FKLI. Okay, this is a daily chart. Okay, the FKLI. This is my trading fractal signal, but don't worry about that first. But just to show you, right, in terms of my trading style, and when it comes to fractal signals, this is a daily chart. So we spoke about position trading using daily chart. This is the first half of 2020. Okay, I will explain all these lines for those that are not familiar with technical analysis. All these lines over here, okay, you will see. Okay, let me show you. You can see some of these signals that is available. I marked over here. So according to my fractal trading system, it has flagged here four what do you call that, selling signals. Okay, and there were about 3 buying signals in the first half of this year in terms of my system showing. Okay, so on the daily chart you can see here this basically 7 signals in the first 6 months of the year. So that's basically about 1 signal a month. So it's about like a 4-week trend, okay, for those signals to develop. In terms of the second half of 2020, okay, so second half of 2020, you could see the markets also came down and then took a very nice ride up. Okay, and this chart actually extends out to January the 5th, but you can see that I had 4 sell signals in my system, trading signal, in terms of what are the signals that generated, and there were 4 buying signals in my system. So basically, in terms of looking at the daily charts, you get somewhat like all these 8 signals in the last 6 months. Okay, so basically about 2-3 weeks per signal for it to develop, right? So which is about what we spoke about in terms of the position. Those are the frequency of the trades that normally you would take in terms of trading, position trading, right? So later we'll go into some live charts, and I will show you for those who are interested in looking at the signals, we will go into the live chat and have a deeper look into it. Okay, so in terms of strategy number 2, which is day trading, intraday trading. Okay, so basically you are going into the market. Okay, when the market is open, you go in and you're hopefully, right, if the trade goes for you by end of the day or before the end of the day, you will be out. Okay, so that's strategy. So you don't want to hold any overnight positions, right? So basically you are in when the market is open, right? So you either buy or sell for example, a FKLI contract, January contract, or short FKLI January 2021 position if you're bearish during the day, with the view to exit on the same trading day. So day to day, it's very, very different. Okay, your view is you want to just want to capture the momentum in the price changes, right, on a daily basis, or the short-term volatility because of news and or whatever events that has what do you call that, has opened up the opportunity for you, right? So of course, in an intraday basis, the movement on a day basis compared to say a couple of days is much smaller. Okay, so you basically want to capture that particular volatility, and your stop losses or your risk is relatively smaller as well, right? So a lot of traders like this because on a day-to-day basis, they can go in and after at the end of the day, they're out. Okay, so they don't have an overnight positions. So the capital required for day trading, okay, although most it requires full margin if you hold it overnight, but in terms of day trading, some of the brokers may allow some allowance or flexibility in terms of the margins required. So in terms of, let's say for example, some brokers may be able to give you 50% margins. I mean, for a full margin requirement, be able to trade 2 lots from one lot capital or margins that you have. Okay, so that's something that you can talk to your broker, okay, and see whether they have those allowances and flexibilities for you. Okay, so that's one possibility because you are day trading. All right. So this is a very interesting strategy. I use day trading a lot as well in my trading. I trade full time. Use day trading. Sometimes I hold overnight. But to me, because I trade only very short term, so I don't do position trades. Okay. So what's the difference in terms of position trades? Now, in terms of skill level, okay, in terms of skill level, some may think that intraday or day trading requires less skill. Actually, no. Day trading requires you hone your skill even better, right? So in terms of for those of you who have just come in to start trading index futures, my recommendation perhaps is to trade position trading first. Okay, don't go too big. You can start on a smaller 1-2 lot basis. Okay, get yourselves, you get your feet wet. But because day trading, it requires you to make a lot of decisions very fast. Okay, so you might not be used to that kind of quick decision making. And you got to buy and sell, you got to react, you got to cut loss, you got to take profit. So you need a bit of more skill if you want to do day trading. Okay, you can of course progress to day trading once you have that particular skill honed. Okay, for those who just come in and just started index futures trading, I would recommend you start position trading first, because then at the end of the day, you look at your position, you size up the trade, and then you form your strategy for the next day. It's a bit easier on your decision making, right? So those of you, this is a tip for those who have just starting out. Okay, so once you're used to it, you're familiar with trading index futures, of course you can jump into day trading, right? So that's in terms of skill levels, you need to look at that. Okay, so let's look at some day charts and see what sort of opportunities are available. Okay, so here you have a FM, this is not an FM70 chart, okay? FM70 chart, because the volumes are still building up, so the charts are still not so nicely constructed. I wanted to show you the FBM70. This is the index chart, the FBM70 FTSE chart itself, just to show you the movement of the FBM70, which is actually very, very attractive movement, okay? And this is a 15-minute chart, okay? This 15-minute chart ranges from the 23rd of December last year until the 5th of January this year, the time when I did this particular, prepared this particular deck, okay? And you can see over here, now you can see the dates here. I don't know whether you can see, it's rather small, okay? Rather small over here at the bottom, 23rd to 24th. You can see even over here, 23rd to 24th, in the span of 1 day, okay, I have 2 buy signals generated by my system. Okay, of course, one of the signals generated late in the day, which I may not take. Okay, but every single day you can see that there are opportunities. Okay, so 25th, there's an opportunity to buy. Okay, this one didn't work out that great. Okay, and then on the 29th, there's another opportunity. So every single day presents opportunities in trading. Okay, and this is a 15-minute chart. Okay, so that's very, very interesting as well. So in the hourly chart, okay, so hourly chart, can you trade intraday? Yes, you can trade intraday, but a lot of people use the hourly chart to trade 1-2 day trends. Okay, so they may hold overnight for a day or two. Okay, so there's very nice trends as well. I didn't put the buy sell triggers over here, but you can see a very nice trend here. Later we'll talk about these 3 lines, which is a very interesting indicator which I want to share with you. This is a very good indicator which I've used for many, many years. Very, very helpful to your trading. Hopefully I'll share with you in a short while. And you can see that there are many, many signals as well. Very nice trends. Okay, there are certain areas that you're not supposed to trade. Later I'll show you how, which are these areas over here. Okay, and then there's nice trends here. Take profit, and there's nice trends here. Okay, so on the hourly chart, you can also see that there are a lot of opportunities as well. Okay, for short-term trading. Okay, now let's talk about this third strategy. We spoke about position trading. We spoke about the day trading. And now this strategy 3 is a very interesting strategy. This is what we call the professional strategy. A lot of my clients that trade futures, professional traders, okay, and they trade in big sizes. They trade this what we call the calendar spreads. Okay, they trade spreads. Of course, not just plain vanilla calendar spreads. They have, of course, more sophisticated spread strategies. But the basics of it is constructed from what we call a calendar spread. Okay, so what is a calendar spread? And basically, a calendar spread is what a trader does. He simultaneously buys and sell the same index futures contract, but different months. Okay, so for example, if I'm trading what we call FKLI spread, calendar spread, I can go in and buy an FKLI January contract and then sell a FKLI February contract. Okay, wow. Why do you do that? Why do you simultaneously buy one January and sell one February? Okay, there are other names for this kind of strategy. It's called intra-market spreads or intermonth spreads. Okay, now the strategy of this trading calendar spreads is basically you want to trade and profit from the difference in the rate of movement between two contracts. Okay, so let's say, for example, I'm very bullish on the market. So I buy a January contract, a January 2021. Later, I'll show you one example. Okay, I'm expecting that January, okay, contract will move either faster, okay, on upwards compared to the February. Okay, so I'm trading the relative movement. Okay, and this is very interesting. Okay, and a lot of these big traders and professional traders, they trade the calendar spreads and sophisticated calendar spreads because there is potentially less volatility in a sense. Okay, it's not so wow. Okay, there's things like overnight gaps and all that. They are not really subjected to those kind of risks. Okay, compared to outright trades. Outright trades, this time we're saying that you have a position either long or short a futures contract. Okay, but in trading a calendar spread, you are not subject to those absolute movement in the index. You're subject to looking at the relative movement is between January and February. Okay, so I'll show you what do you call that, examples just to make it clearer, right? But here, take note that the capital required to trade calendar spreads are less than outright positions. And we've seen this now when I told you to note the spread margins required for each of those FKLI and FM70, right? But let's look at example now. Let's look at this. Okay, so this is the example, hypothetical prices. I use this because when I prepared, it was somewhere early of this month. Okay, so let's say, for example, I buy FKLI January and I sell February FKLI. Okay, two different months. One is a buy, one is a sell. So in on the 4th of January, okay, these are the prices. For example, I bought FKLI at 15.95 and I sold FKLI February at 15.98. Now, we want to notice the difference between these two prices. Okay, the difference between the January and the February, the difference is 15.95 minus 15.98 is a -3. Okay, that means January is lower than February. Okay, so I have a -3. The spread is -3. Okay, now, so what am I trying to do? So I'm bullish. Basically, in this strategy, I'm bullish. Okay, so this is the position I have, a January and February spread, bought on 4th of January. And this is the spread we spoke about, -3. Okay, now on 14th of January, okay, incidentally is today. Okay, I just put basically a 10-day difference. Okay, and these are hypothetical price. Okay, I haven't seen the closing prices for FMs. This is FKLI today yet. Okay, so what is my profit potential in this strategy? Okay, my profit potential is if my spread between these two contracts increases or widens. Okay, so now is -3. So if it widens larger, it moves a more positive figure, then I will make money, right? So on the 14th of January, hypothetical price, let's say, for example, January closed at 16.25 and short February price I shorted, and now it's at 16.18. Okay, and you can see here actually February when I shorted, now it's higher, so I will actually be making losses on, in terms of index points, I lost 20 points, but in terms of the long January, I made 30 points. Okay, so in terms of looking at the spread on the 14th of January, is 7 points positive. Okay, so my January is now higher than my February, which is 7 points. So the difference between minus 3 to 7, those are 10 index points. So there's a difference, right? So what did I make? Okay, 10 index points. One index points, of course, is 50 ringgit. So I made 500 ringgit on this strategy. Is it? Wow, big deal. 500 ringgit, you waited 10 days. So some people for this kind of calendar spread, it may not be suitable for them. Some of the traders like absolute risk or absolute price movements. So I've taught this strategy before to some of our clients previously, and they say it's like watching grass grow. Very slow, yeah. But then this is called a professional strategy. Professionals trade this strategy, and it's a very profitable strategy if you know how to do it, right? So in terms of looking at, just now we said 500 ringgit, right? Okay, you need to remember this. The margins for trading FKLI spread, okay, is 750 ringgit per pair. Okay, just now we already spoke about that, 700 ringgit per pair. Okay, right at the bottom here, you can see FKLI spread margins is 750. Now you made 500 ringgit with a capital required for this spread, 700 ringgit. So if you look at the returns in terms of the capital you put out, it's extremely, extremely decent. Okay, so this is, you basically take less risk, okay, in terms of absolute movement, but the returns can be just as lucrative as itself, right? So I would encourage some of you who have not looked at calendar spreads before to have a look at calendar spreads. It's a very interesting strategy. Okay, you may be like watching grass grow, but I think it's this one way of watching grass grow which is very profitable. Okay, so for those of you who have not seen or have not ventured in looking at trading calendar spreads, do have a look. It's a very interesting strategy that you may find surprisingly beneficial to your trading. Okay, and in terms of looking at this is the FKLI calendar spread. Okay, this is the difference between the first month and the second month. I just chart it out. Okay, and you can see basically in terms of the overall, this is from this is quite long term. This is from 2014. So this is like 6 years of spreads. Okay, and you can see this is a daily chart, of course, and you can see the spread normally ranges between positive 5.5 to minus 5. Okay, so a lot of times when traders see the spread go up above 5.5, they tend to think that, okay, it will normalize. So this strategy is a bit different from the outright taking a position of where the trend of the market is. It's basically looking at a relative movement, and okay, anything above positive 5.5, they will tend to look for opportunities to sell a spread, and if it's below 5 or near 5, they look at opportunity to buy a spread. Okay, so I won't spend too much time to talk about the spreads, but I want to introduce it to you so that you can have a feel of what calendar spreads is about. FKLI calendar spreads have been traded for a long time. This is favorite strategies among the professionals. Even in the Malaysian palm oil market, spreads is one of the very, very favorite strategies. Okay, so do have a look at it, because it is a strategy that I encourage you to explore further. Right. Okay. So we've covered 3 different types of strategies: a day trading strategy, a position trading strategy, and a very unusual, not unusual, it's actually usual. This is a lot of retail traders don't look at it, the professional calendar spread trading. Okay. So these are the 3 commonly used strategies for index futures trading. Okay, so we've covered some strategies. So now it's the time to talk about reading the markets and trading it. Okay, share with you some ideas on how to look at markets, how to read the trend, how to go into a trend when the market trend is there, and when to stay out. Okay, how do you identify those phases in the market? Okay, so obviously when you're trading, those who have traded for some time, you will have heard this. You may have learned from classes or read books about it. They always say the trend is a friend. Okay, so you always want to be with the trend, whether it's an uptrend or downtrend, because the trend is a friend. Okay, now the thing about this trading advice is when trends are there, it's very obvious. Okay, it's very obvious to the eyes that the market's up or the market is down. Okay, and until it's not. What do you mean by until it's not? Okay, when it's not a trend, a lot of people can't recognize that the trend has ended or the trend has changed. Okay, so traders are often very profitable, of course, during the trends, if you call it, okay, and suffer losses when the markets go into what we call the congestion or the correction market, when it's no longer a trend, right? So the key thing is how to identify what tools can be used to identify when to go in when the trend is there and when to stay out when the trend is not there, because traders tend to lose money when there's no trend, right? So how to determine a trend, recognize a non-trading market, a non-trending market, and that will give you the decision when to stay or when to stay out. Okay, so let's move on. So we need to have a compass. Okay, I want to share with you a compass today to navigate the markets. Okay, this compass is very important because it shows you where you're heading to, where's the market direction, where's the market heading to. Okay, this is number one, to protect your trading capital. Okay, not to lose money when it's going nowhere, in the rocky, when the market in the rocky seas, you don't want to be trading in that kind of situation. Okay, corrective markets, you don't want to be there, you want to stay out. Okay, and then to also have this tool to monitor the market momentum. Okay, let me introduce you to this tool, and this tool is called Bill Williams Alligator. Okay, very interesting name. Okay, Bill Williams Alligator, I use it as my market compass. Okay, and I've used it for many years. More than 20 years I've been using this indicator. Okay, it's available on most popular technical indicator screens or platforms. For those who want to learn a bit more about it, I have put a reference there. You can reference this book called New Trading Dimensions by Bill Williams, John Wiley and Sons, 1998. This is a very good book. Okay, so what is a Bill Williams alligator? Okay, if you see here on the right side on this dark colored slide, you can see here three lines. You can see a blue line, a red line, and a green line. Okay, and these three lines are basically moving averages. Okay, these are 13 period, 8 period, and 5 period moving averages. Okay, don't bother about how it is constructed, because the trading platforms will actually construct this for you. But this explanation of how this is constructed, there are three lines here, and all these, of course, are price. These are price of the. This is FKLI. Okay, these are the prices, and these three lines interpose on the chart of the price chart. Okay, and we will see how to use this Bill Williams alligator market compass. Okay, it's a very useful tool, and this indicator have been designed after many years of research by Bill Williams, and is based on fractal geometry and non-linear dynamics. Big words, but don't worry about it. When you use it, you don't. It's not rocket science. Okay, so let's move on to the next one. Okay, how do you read the Bill Williams alligator? Now, let's look at it. Let's just have a closer look at the Williams alligator. You can see the lines over here, and there's squiggly lines are going up, down, and then you can see they are white lines, and then it narrows down and it goes wide again, and it goes narrow again, and starts to widen again, and then narrows and widens again, and narrows and widens again. Okay, so now when all these three lines, or what we call jaw, teeth, and lips, these are just fanciful names for these three lines, jaw, teeth, and lip, comes together. Okay, Bill Williams says that this market is what we call the alligator is asleep. Okay, this when it's scrunched together, the alligator is asleep, and when the alligator is asleep, means the market is range bound. Okay, so when you see, interpose this indicator onto your chart, and you see it's not widening, it's narrowing, or it's bunched up together. Later we'll see some chart examples of that. The market is in a range bound market, and it's sleeping, and you don't want to be, you want to be out of the market. Either you have taken some profits or you have no positions. You will stay out from the market if you see the Williams, the alligator, in that phase. Okay. Now, when all three lines are spread out, as you see over here, okay, are spread out, the market is in a trend. The price movement is strong. Okay. And in terms of the alligator, is hunting for prey. Okay, whether it's a bull market or bear market. So, okay. So when the alligator is hunting, you want to join the hunt. Okay, whether it's a bull hunt or bear hunt, you want to join the hunt. That's where the trend is there. So you can see over here, when the lines have widened up, the trend is confirmed, and then it's moving upwards in these terms. Okay, so when the lines, the prices are above the three lines, it's on an uptrend. When it's below, it's on a downtrend. Okay, so again, after the alligator, let's say for example this phase, okay, it's open up, and then when it's eaten enough, it will fall asleep again. It will go into its range trading. So these are the ups and downs and the rhythms of the markets. It moves from trends to non-trends, and then moves to trends, and then non-trends. Then it changes trends, and then it moves to non-trends. So it's part of the market dynamics. So using the alligator, you can measure which phase the market currently is. Okay. So in an uptrend, the market prices, like over here, you can see the market prices are above the tree lines. Okay, above the alligator, meaning that the prices are on uptrend. And when prices are below the alligator, okay, these prices are below the tree lines, is on a downtrend. Okay, so that's how you read it. Okay, so widening lines means strength, trend is gaining strength. Narrowing lines mean trend is losing. Okay, so with just one indicator, you can read all these things. Okay, the strength, the whether the market is in a trending or non-trending. Okay, so we will apply this Bill Williams alligator in the next few charts just to give you a better understanding. Okay. Okay, now this okay, later we'll jump into that thing, but let's look at this particular thing. Okay, you may now actually have you may have you're trading some of your trading systems or some of the indicators that you may be using. Okay, so you may say, hey, how do I apply this alligator filter? Okay, using the alligator as a filter. Let's say, for example, I'm trading a particular system, okay, and then I want to use the alligator as an additional filter or additional indicator. So if you are buying a market, okay, this is using an alligator filter for long signals, okay. So you only take long signals if the prices are above the alligator and it's opening up. Okay, so let's say, for example, you have a buy signal on your trading system, whatever indicators you're using. You can go in the alligator and counter check whether the alligator is, the prices are all above the tree lines or not. Okay, so if it's all above the tree lines and it confirms with your system or confirms with your indicator, then it's another added filter to show that the trend is up. Okay, so you can use the alligator that way. Now, if you are, this is an example for short signal. Okay, if the alligator prices are now below the tree lines, you can see that it's below the tree lines and the lines are opening up, then it's showing you that the trend is gaining strength. And if your indicator or your system is also in synchrony with the alligator, then the alligator is basically confirming your signal as well. Okay, so for those who are using their own indicators, you can use the alligator as an additional filter, okay, to measure, to see whether the trend is in sync with what your trading system is using or what your trading system is indicating. Right, so I would use it that way. I use the alligator as a filter for my fractal signals as well. So when my fractal signal gives me a buy or sell, then I look in which phase is this market. Is it in a sleeping phase? You can see over here. This is a sleepy phase. If it is sleepy phase, I will try to avoid. If the prices are inside the alligator mouth, I will try to avoid. Only when it gets out and the alligator starts to open its mouth, then I will take that direction. Okay, so that helps you to sort of filter out or remove all those times when the market is in a sideways market. Okay, so this is a very, very useful indicator for timing your trading phase, whether it's on a trend or in a non-trend. Okay, so this is one example, okay, of the chart. Just now you saw this already. This is a daily chart of the FKLI. You saw that in the beginning when I show you the position trading. This is the start of the year. And you can see that all my sell signals over here are all below the alligator. Okay, over here you can see the alligator is bunched up. Okay, so when it's bunched up, that means it's in a sideways trend. Okay, so you don't take signals when it's trading over here. And then I have a signal on my fractal which is below. That means the trend is down. Okay, and when it's triggered, I will sell. And I took all the sell signals when it's below the alligator. Okay, so all the cells are below the tree lines. That means the trend is confirmed. And as it widens, you can see over here, of course, this is a huge dip caused by the COVID-19 and the fall in the global markets at the beginning of last year, the first quarter of last year, after February, after Chinese New Year, when we came back, this huge drop. Of course, a huge opportunity here if you caught the trend. Okay, there were a couple of sell signals over here in my system. Okay, and then it went back to sleep. Okay, you can see over here, of course, it rebounded. Then it went into consolidation inside the mouth of the alligator. Okay, so when it's in the mouth of the alligator, it tends to be range bound. So these opportunities I don't take. And then after that, my fractal system showed me buy signals above these three lines. Okay, so you can see over here, there's the buy signal here, and all these are above the three lines. Okay, and it really took off here when the over here it's actually going on a sideways as well. Okay, so you may say that, okay, this particular signal is not too good because it's so close to the alligator. Okay, so me want to take a signal right over here, which is perhaps a better signal. Okay, buy signal over here with the lines opening up, and the trades are all, the prices are all above the three lines. So this is a buy signal, and this is a very good trade, of course. And then over here, it comes back into the alligator's mouth if you want to take some profit. And again, then it started its uptrend again for the FKLI in the last half of the, in the last second quarter. Okay, in the second quarter, that means the last part of the first half of last year, started to move again. This is somewhere in July. It moved upwards again, right? So, okay, let me show you let me share some live charts over here. Okay, let me see whether I can get to the live charts. Okay, sharing screen, new share, so that we can look at some examples. Okay, let me share the screen. Okay, I hope you can see this. Let it load. Okay, yes. I'm going to change my view. Ryan, do you see the screens?
Can see your graphs coming up.
Okay, good. Okay, so let's move to this. Slowly loading over here. Okay, I need to look at this bigger chart. So excuse me for facing this way. Okay, so this is live chart. So you see the chart updated until today. Okay, so this is a FKLI daily chart. Okay, so in the old chart, you saw there was a sell signal over here. And now, if you look at it, then we have prices now moving above the alligator. Okay, it has come into over here. Right, you can see that this was a continuation from last year. There was this uptrend. Okay, the prices trading above the alligator, so it's on the uptrend, a very good uptrend. And then when it came back to this consolidation range, when it went inside the alligator, it's time to take some profit. There was a sell signal here, which it was profitable, but not greatly. Okay, and then you have an alternative buy signal, which just happened 2 days ago, yesterday actually, and this is today and yesterday. Okay, so in terms of looking current situation here, it's above but not convincing yet. Okay, because the alligator is still what do you call that, bunched together. Okay, so you may not want to take this signal because you say, okay, I need the things to open up first. Okay, so in terms of using the alligator to trade as well, in terms of filtering, this is how you use it. Okay, let's look at the FM70 for some trends as well. See how it looks like. This is the FM. I need to use the index itself rather than the FM70 because, as I said just now, the charts are not so good looking at this present moment until so here goes. You see, I have this now. You can see over here. This is the FM70 chart. And it's this is an hourly chart. Okay, so in terms of trading, this is a 1-2 day trend. So in terms of the 1-2 day trend, currently the mid FM70 chart, BM70 chart is above the tree line. So currently it's on a short-term uptrend. Okay, so this is how you use the alligator. Okay, over here you can see somewhere in the end of the year. 2020, there was a sell opportunity over here, which developed actually quite well. If you can see here, it developed for about across actually about 3 to 4 days, right? So if you sold, say for example, you had an opportunity to sell, there's a fractal signal sell here around the 15100 levels, okay, and then it came down to a low about This level is about the 14,200 levels. There's an opportunity of something like 800 to 900 index points on the FM70. So multiplied by 4, it's quite a sizable trade for a couple of days. Right. So over here as well, if we took a signal right here, there was this fractal signal over here. The buy bar was over here. The buy signal around 1456, 14,560, and now it's 14,800 something. So that's like a 200 point profit potential as well. Right. So the trend may continue to move. Okay, we will see and monitor how this goes. Right. So it's interesting how useful this alligator can be for your trading. So I hope you can use this if you find it useful. Okay, so let's, I'm going to go back to our slides. Okay, let's share something else, new share. Let's go back to our slides. Yes. Okay, are we back? Let's see whether I can. Okay, no, wait, let me just click again. Okay, we are still in my live chart. Okay, just give me a second. Go back to my PowerPoint slide. Okay, so okay, there's this section that we want to talk about the entry and exit. So we looked at some charts and how to trade the alligator. Now, before you go into any trading strategy, you need to know where you land before you take off, right? Before you enter the market, you must know where you're going to land. This is very, very important in terms of trading. It's critical, right? So in any flight plan, if you are a captain manning an airplane, before you even take off, you should know where you want to land, right? So good trading is all about exits, okay? And as you know, in most of the time, money is made when actually not when you buy or when you enter. It's actually when you sell, when you exit. That's a very important point, right? So even a monkey can enter a trade. You know? You can press the computer, and then but the money is actually made when you exit. Okay, so it's very critical to have an exit strategy. An exit strategy has actually 3 components to it. One is stop losses. Okay, stop losses are, okay, what happens if the trade don't go for you? Okay, do you have a stop loss strategy? The other thing is profit taking. So the market goes for you. So where do you take profit? So you need to have a strategy for that. And the third one is it exits if the trade is not going anywhere. And this is pretty simple. If the trade is not going anywhere, you want to preserve your capital, or you want to use your capital where the markets are moving. So do not trade a market that doesn't move, right? Obviously, it's of course, if you're spread trading, that's different. But if the market doesn't have volatility, then you don't trade that market. So in terms of if you enter the market and it goes into a phase of not going anywhere, we said just now, if the market is sideways, it's not profitable, so you want to get out if you find yourself in that situation. So in terms of looking at the, excuse me, stop loss, the stop loss is one of the most critical lessons in trading futures. Okay, the last session we talked about the margins and the leverage of futures trading. Okay, so you need to have a safety back. Okay, it's like trading futures is like driving a sports car. It's a very fast car. So you need to have safety features when in this car. And these safety features are what we call the stop losses, right? So in rate, it's a very important advice when you're trading futures. Do not trade if you do not have a defined stop loss strategy. So this is very, very important. If you don't know your risk or you don't know where you're going to take a stop loss, do not enter a trade. Because why? Not all trades can be winners. That's one of the things that you need to realize. Not all trades can be winners, right? So the stop loss is there to preserve your capital for the winners that will come, right? So every time before you enter a trade, or every time you already put in a trade, immediately put in a stop loss order, right? So you must know your exit before even entering any trade. Okay, so in terms of stop, a general guide is to put a stop where a loss does not exceed 2 to 5% of your equity. Okay, do not risk too much of your account balance in any one trade. So the good guideline is not more than 2 to 5% of your account equity. Okay, that's where it's a good stop loss as a guide. right? You have two types of stop losses: a fixed dollar stop or a technical stop. Okay, so fixed dollar stop is basically you define your risk. Okay, as you can see over here, you define your risk. Okay, and that's like 2 to 5% maximum of your protective stop. Okay, and you apply it per contract. Okay, sorry for the typo over here. And for example, if your stop size is 500 ringgit, means that your stop price is calculated that if the stop is hit, the loss will be 500 ringgit per contract. Okay, now if it's technical stops, then this technical stop is of course based on your charts or your technical indicators. And in terms of technical stops, again, the guideline is the technical stops should not exceed your fixed dollar stops as well, which it should not exceed 2 to 5% of your account equity. All right, so this is guideline for taking stop losses. So let's move on to profit taking exits. Okay, you need to also have a systematic profit taking strategy to help fight the emotion of greed. Now, this is very important, okay, because when you trade, you have this fear and you have greed in terms of emotions when you're trading. So in terms of fighting the emotion of greed, one of the good strategies you need to have is to have a profit taking exit strategy. All right, and this is where you can have a consistent profitable results. So in terms of profit taking exits, the guideline and the aim is to have at least a profit size which is 2 or more times the risk that you take. So if you're taking a stop loss of 500 ringgit, then your profit size should be 1,000 ringgit or more, basically 2 times or more of the risk that you take. Right. Similarly to profit take exits, you have the fixed dollar exits, and you also have the technical exits. Okay. And one last extra in terms of profit taking is trailing stops. Trailing stops is very, very good because trailing stops is a stop where you can actually maximize your profit potential. Okay. So fixed stops is similar to your fixed dollar stops. Basically, you define your target for your profit taking. Right. So in terms of, let's say, for example, just now we took a 500 stop loss, then you should have at least 1,000 ringgit in terms of your target profit. Okay. So for consistent profitability in your trading, you should have 2 times your stop losses or 2 times your risk. Okay. Technical profit exits are very similar, but this you take your exits based on your charts or your technical indicators. And trailing stops is where you move your stop order. Let's say, for example, your trade is going for you. You will progressively move your stop loss higher and higher. Let's say, for example, you say your stop loss is 500 ringgit. You will, every time it moves up to a profit of 500, you move your stop up. So this is with the attempt to make the maximum, write the maximum out of the trend. Okay, so that's something you could do. Let's say, for example, you identify a trend with the alligator is really opening up its mouth. You want to follow that trend. You continue to trail your stops up, okay, to maximize the stop. So it helps you to take profit. And if the market turns, then automatically you will lock in the profit for you. Right. So in terms of looking at stop loss and profit taking strategies, these are the 2 strategies that you can use in your trading. Okay, so to end, this is a roadmap. Okay, to start trading index futures for those who haven't started. Okay, number 1, of course, to open an account with a licensed futures broker, very important. Okay, only open and deal with a licensed brokers. Okay, there's a list of the licensed brokers on Bursa Malaysia websites. There is section. So go and have a look at the trading participants that are licensed to deal in futures. Okay, then research and learn the various strategies. Okay, today we are covering some of them. The various strategies and trading methods that are available. We shared 3 today. Okay, we have the day, the position, and also the spread trading. Pick the strategy that you think you're comfortable with. Okay, so if you are willing to have a slower, but more, it equally can be profitable as well. A slow and steady strategy, maybe you want to trade spreads. Okay, if you have a slightly better appetite for risk, okay, you can trade position trading or even day trading, the strategy that you're comfortable with. Okay, then determine what risk capital. This is important as well because the risk capital will decide what size you're trading in terms of what positions can you take. Okay, determine what is the risk capital. Then when you're ready to start trading, you deposit that margins with the broker that you've opened an account. And then my advice is if you're new to trading index futures, start smaller. Okay, start smaller and then grow your account as you get more familiar with how to trade, and if you have found a good strategy, then you can of course trade larger. Okay, as your skill and familiarity with the instrument increases. All right, so that is the last slide. We can go into Q&A now. Okay, I hope some of you have put in the chat for Q&A. I will pass back to Ryan to moderate the Q&A. Ryan?
Hi, David. Thank you.
Hi,
It seems that the audience members, there's no questions at the moment. However, I was wondering, how much returns can I expect to make from trading index futures?
That is a fantastic question that everybody asks. Okay, you've seen some of those strategies that we spoke about, and basically a lot of people say, hey, I'm into futures, and I heard in futures you can make a lot of money. Yes, indeed, you can make a lot of money. Of course, because of the leverage as well. If you're not careful or you don't know what you're doing, you can lose a lot of money as well. So how much money or how much returns can you expect from index futures trading? Okay, now it's depends on a few things. Okay, it depends on, number one, your skill and experience. Of course, with better skill and experience, you will enhance your trading, your methods and strategies as well. Right, certain methods have what do you call that? More aggressive, and certain methods are more conservative. Right, you've seen the three strategies today. Some of it is conservative, some of it are aggressive. Okay, so realistically speaking, okay, in terms of looking at index futures trading, generally a trader, if he can make 25 to 40% return on his capital on a per annum basis, he could be actually quite happy. Right, I know Malaysian traders tend to be more aggressive, and they always tell me, David, you 25 to 40% only. They say so. I say yes, realistically and consistently, right? Not the making 300% in 1 month and then losing another 300% the next month. Okay, so consistently, generally traders are quite happy if they can make 25 to 40% per annum on their capital. Okay, but many traders do make substantially more than that. There are a lot of traders that I know that make more than that, of course, right? It also depends on how much capital you employ in your trading, okay? But bear in mind, when you first start out, you need to be realistic, okay? You know that you just started, okay? So you should be a bit more conservative when you first start. The first important objective of when you first start trading is preserve your capital first while you learn the ins and outs of trading and ins and outs of index trading. And then when your skill is there already, then you can get to be more aggressive, right? So generally, if you can get 25 to 40% when you after say 1 year trading, you can say yourself to be a very, very happy person. Okay, but some people have a lot more aggressive objectives than that. I hope that answers the question, Ryan.
It does. Thank you, David. I'm sure the audience are burning to ask the next question. How much capital do I need to start day trading index futures?
Day trading. Everybody loves day trading, because I guess there's so much talk about day trading. If you visit online portals or you see a lot of these ads popping up on your sidebar when you're surfing the internet, make a living day trading and all that. Okay. Now, day trading in terms of the capital. Okay. If you ask me, I will, because I'm quite conservative in terms of taking risks. Okay, although I take risks on a daily basis. Okay, I'm tend to be more conservative. I will trade day trading. You should start with the same capital as you are trading position trading. So in terms of looking at starting capital, so we're talking about, I probably understand that you say what's the minimum you should start, right? So last week there was this question about what is a good capital to start index trading. I would say that you need to start at least 10,000 ringgit. That's, I think, is the minimum. Okay. So in terms of the minimums, I think there is no difference between position trading or day trading. Okay, but day trading, as you know, the brokers may give you a bit of flexibility to trade a bit more, because if you are consistently are able to close out your positions at the end of the day, then the broker will be quite comfortable with your discipline. And then that's good, because you don't take overnight reads, so they can give you more flexibility. So in that sense, day trading, let's say for example, for a capital of 10, you may be able to trade more than 1 or 2 lots of it compared to position trading. Okay, but in terms of minimum starting capital, I would recommend that you still start with 10,000, similar to position trading, so that you have enough buffer to withstand the ups and downs in your account. I hope that answers the question, right?
Absolutely, absolutely. And where can I get the software to display the alligator indicator?
The alligator is, fortunately these days, the alligator is a very popular indicator, and it can be found in most, platforms. Most of the Bursa broker platforms, I understand, have already got, this indicator called the alligator. Now, if you don't have this particular alligator indicator, I would recommend, and a lot of the free online platforms these days have this particular indicator as well. If you surf the online channels to look for prices on FKLI and all that, they already have that. I would recommend, if you like, you saw my charts just now on the screens, and those are the charts that I use personally. You could actually use those charts as well. It's called TradingView. Okay, TradingView is there is a free subscription where you can join in as a free member, and it gives you a lot of charts and technical charts, and part of it is the alligator. You can subscribe to it if you want the more higher level ones. But in terms of the Bursa real-time prices, real-time prices, you can actually get it for $1 a month, which is a very affordable price to have real-time data. Okay, Bursa Malaysia derivatives have actually made it very affordable for retail traders or individual traders to actually have the real-time price feed. And TradingView carries that trading price feed for only $1 a month. If you want the more sophisticated, if you want something beyond alligator, you can subscribe to the higher premium packages on TradingView, which gives you more sophisticated charting. Okay, I'm not affiliated to them. I just use the software. It's my day-to-day program, which I find very, very useful, and it's one of those that I can recommend. Highly. Okay, there are of course a lot of the local service product providers as well. Those of you who have been trading quite some time, they know names like NextView and all that do have this indicator in the platforms as well. Those are some of those platforms we have used before. So if you're looking for a platform that has those, I think they have a couple of good choices. But firstly, go and check out with your broker first. They may already have that platform. It's available for free and real time as well. So there'll be a good starting point. If not, then I would suggest going to TradingView as a good economical start to looking at where the alligator is. I hope that answers the question.
Absolutely.
Ryan.
Good stuff. Thank you, David. I think with that, we come to the end of tonight's webinar. Ladies and gentlemen, please remember the 4th of February at 8 o'clock. We will do number 3 in the series of this 3-part webinar. We want to also say thank you to the audience once again for joining this webinar. And thank you, David, for sharing your insights and thoughts on the strategies you need to know for trading stock index futures.
Thank you and good night.
Pleasure. Please take note, this webinar will be available on www.bursaacademy.bursamarketplace.com for you to view again. With that, I wish everyone a safe and good evening. Good night.